Online health company Hims is one of the best performing stocks on the market this year, with shares up 167% year to date. However, it's also one of the most shorted, with a short interest over 30%. So does this stock have more room to run, or is it a bubble waiting to pop? At the recent price, Hims now has a market value of $15.9 billion. Revenue over the last 12 months comes to $1.78 billion, with $164 million of net income, $236 million of adjusted EBITDA, and $248 million of free cash flow. So Hims stock is valued at almost 100 times earnings, which sounds expensive, but the company is growing incredibly fast. Boosted by the introduction of GLP-1 weight loss drugs in early 2024, revenues grew an impressive 69% last year, and that growth continued into the first quarter, where sales more than doubled and adjusted EBITDA hit $91 million. But despite strong performance, the bear case for Hims is fairly straightforward. The company spends huge amounts on marketing, around 39% of revenue, and critics say the company offers too many treatments without adequate medical consultation that could lead to potential legal issues down the road. The biggest issue for investors, however, is the future of weight loss drugs on the platform. Now that key ingredient semaglutide is not on the FDA shortage list, Hims is no longer allowed to sell compound versions of the drug. Since weight loss drugs were almost 40% of Q1 revenues, future growth should come under pressure. In fact, company guidance suggests that revenue will likely decline next quarter. Hims should keep some weight loss revenue going due to its personalized plans and the company's recent partnership with Novo Nordisk. But the Novo Nordisk partnership is likely to be much less profitable for Hims. And why would customers buy from Hims when they can get the drugs much more cheaply directly from Novo Nordisk or Eli Lilly? Even so, there is a case that bears are underestimating the power of the Hims platform. After all, Hims was growing nicely before it even introduced GLP-1s. The company's other categories, including sexual health and dermatology, still made up 60% of revenues in Q1 and 85% in 2024. And if company guidance is correct, then top-line revenue should grow 30% this year, even without the contribution from GLP-1s. So what is priced in? According to a simplified reverse discounted cash flow model, Hims would need to grow top-line revenue about 20% a year for the next 10 years to justify the current share price of $65 a share. That's using a 10% discount rate, 2.5% terminal rate, and a free cash flow margin getting to 20%. That's possible, but it doesn't leave much room for upside. The stock might benefit from a short squeeze, but considering the uncertainty around weight loss medication, it may be safer to wait for a better entry. But these are my personal opinions, not financial advice, and I hold no position in Hims stock. For more investing videos, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.